Good
Okay.
afternoon. Oh, sorry, Dorian.
No,
Let me
it's all
just
right.
let me just make a small introduction, and then I will hand over to you if I may. Good afternoon, ladies and gentlemen. Welcome to the Belvoir Group investor presentation relating to the final results for the year ending 31st of December 2020. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it is appropriate to do so. These will be available via your Investor Meet Company dashboard, and we will notify you by email when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and if you could give that your attention, I'm sure the company will be very grateful. And I'd now like to hand over to Louise George, CFO, and Dorian Gonzalez, CEO from Belvoir. Good afternoon to you both.
Good afternoon. Thank you for
Good afternoon.
the lovely introduction. That was very, very kind of you, and thank you to all of the attendees for kindly giving your time to listen to us today. Well, the format. So we've got a presentation where Louise and I do it between us, you know, like a sort of double act. I do the first part, Louise does the middle part, then I'll come in and do the sort of final part. And please, as Mark said, please ask questions, and we'll either address them through the presentation, or we'll keep them until the end and we'll answer, or a bit of both. So what I'll do is now we'll turn our cameras off, and just to preserve bandwidth, and we'll go into the presentation. So camera off. Okay, so first of all, just a brief introduction to myself and to Louise. So my name's Dorian. I'm the Chief Executive Officer. I've been in the property sector for 22 years, and I've got 16 years service at Belvoir. During my time at Belvoir, I've also been a voluntary director of the Property Ombudsman, which is the property redress scheme, or the main property redress scheme for complaints about any type of property in the UK. And key skills: franchising, people management, business development, and really sort of business growth across the board. Louise, CFO, 17 years as board member, 7 years at Belvoir. We make a great team. You can see from our results over the last sort of 4 or 5 years that we work extremely well together. And in terms of sort of investment in the company, we both have shares in the business, and we both have incentives going forward which relate to share options. That's just a brief introduction. Okay, so what sort of business are we? At the heart of the business, we are a franchise network. So we are estate agents, we are letting agents, we also have involvement in arranging mortgages, but at the heart of all of these branches that you can see on the top line, so Belvoir, Northwood, Lavelle, Newton Fallowell, and more recently Humphreys, we do have a franchisee at the sort of heart of every one of these businesses. That's a very important point, in that if a franchisee is running their own business, they are motivated to grow their business each year. We were tested to the full last year when we locked down sort of March to May, but as soon as the restrictions were lifted, whereas with some corporate estate agency chains it may have taken 2, 3, 6, 7 weeks to reopen that business in a COVID safe way, you really couldn't hold our franchisees back, simply because it's their business. They've got 100% skin in the game, and the franchisees choose to operate as one of these brands. And I'll move on to the brands individually. So, you know, what have we got at the moment? What do we look like? We've got 318 lettings and estate agency franchises spread all across the UK. That includes Wales, Scotland, and Northern Ireland. And we also have a financial services division. So these businesses are spread across 418 individual businesses, 318 property, and 100 financial services. That excludes the acquisition that we made about 10 days ago, that you may have seen by means of RNS. We purchased a company called Nicholas Humphreys. It's a lettings business, a student lettings business, operating from 21 offices, 18 of which are corporate, 18 of which are franchised, 3 of which are corporate. We completed on that deal sort of a week and a half ago. So when you add on the 21 Humphreys offices to the the 418 total, we're a network of 439 locations, sort of individual businesses across the brands that you can see. So when we first listed back in 2012, we didn't have any of these brands apart from Belvoir, just the one. And over time, we've acquired a number of additional brands. Belvoir is a lettings franchise, so 90% of the revenue within the Belvoir brand, and you may have seen some of the the shops on the high street, but 90% of the revenue that franchisees generate from within Belvoir is from residential lettings, and 10% is estate agency. That's exactly the same in Northwood. Northwood's a fantastic brand. We acquired this franchise network, the Northwood franchise network, in 2016 from two private individuals. And again, Northwood, very similar to Belvoir. It's a strong brand, 90% residential lettings, 10% estate agency. And interestingly, during the first lockdown last year, when we were told to close our doors for 2 months, both Belvoir and Northwood franchisees retained 90% of their revenue, even with their doors closed. So tenants continued to pay their rent. We still continue to act as managing agents. Therefore, Belvoir and Northwood franchisees preserved nearly all of their income, even with their doors closed. That was different for the estate agency branches. So across to estate agency. So Newton Fallowell on the so firstly, Newton Fallowell. So Newton Fallowell we acquired in 2015. That business was essentially an estate agency business operating in the East Midlands. We then added another estate agency business to Newton Fallowell called Lavelle. So if you've ever sort of driven along the east side of the sort of Midlands, you may well have seen some of these boards around on for sale properties or to let properties. Both very similar. So across Lavelle and Newton Fallowell, income split is 25% from residential lettings, 75% estate agency. So very much an estate agency business. And then Humphreys, that I mentioned a few minutes ago, that again, revenue split, it's very similar to Belvoir and Northwood, 90%, well, it's 87% residential lettings and 13% estate agency. Why the lettings is important is that revenue is recurring. So in our business overall, 60% of our operating profit comes from the recurring revenue from residential lettings. That's always made us very popular with investors. And then after growing our footprint from listing, from the first point we listed on AIM to the footprint that we've got now, we're currently working on overlaying financial services under the banner of Mortgage Advice Bureau across our network of property offices. Mortgage Advice Bureau is a listed business in its own right. At the moment, we have 202 mortgage advisors. These are our own mortgage advisors, either employed or self-employed with us, but they operate under the Mortgage Advice Bureau brand and system. We've added another 10 advisors to this 202 in the last 3 months. So we're now in real time, we're at 212 advisors, and as I said, 439 offices in total. So just a few key highlights. So we've put, sorry Louise, I think we flicked on a bit there, over to you. That's it. So just a few sort of key highlights. On the left-hand side, we've got some financial highlights. On the right-hand side, operational, and then we'll dig into the detail of these very shortly. So financial highlights, revenue last year up 13%, 21.7 million. MSF, which is our recurring revenue in terms of royalties from franchisees. So if you're a franchisee of any franchise, you pay a percentage of your gross revenue to your franchisor in return for website, operating system, compliance in some cases, brand, way of working, training for a business system. So that we call that MSF, management service fee. And MSF, despite COVID and despite being closed for 2 months last year and operating under restrictions for pretty much the whole of the year, MSF still grew by 3%, which is a great result. Profit before tax up 20% to 6.7 million, and an EPS up 14% to 15.1 pence. Interestingly, EPS is up 165% over the last 4 years. On the operational side, Lavelle, I've mentioned, so that was an acquisition that we made in January last year, and I must admit, completing on an estate agency chain in January of last year made me a little bit nervous when COVID started to sort of embed itself and lockdowns were announced. But actually, it's worked really well for us, because with the stamp duty holiday and lots of activity in the property sales sector, I'm glad that we had a larger footprint due to Lavelle, and Lavelle performed very well last year. So I mentioned the number of offices, so it's up 6% last year to 418, and it's now up a further 21 with the acquisition of Humphrey, so that's now at 439. Financial advisors again, so purely by organic means, we grew our advisor base last year by 22%, which took us up to 202, and then a further 10 so far this year. So we've made good inroads in terms of financial advisor growth without having to make any acquisitions. The final bubble is the strategic alliance with Nottingham Building Society. Really, that's a partnership between us and NBS, whereby we're looking to occupy their premises. So NBS has around 50 building society locations, some of them in very good positions on the high street. We're looking to share window space, put a desk in these offices, or some of them, and in some cases a franchisee or a staff member will sit in inside the NBS office. And I'll show you some pictures and just a bit more detail on that shortly. Okay, so COVID in general, I won't spend too much time talking about COVID, because I think we've covered this, I think, pretty well over the last 12 months. We came out very early, sort of April last year, and with a new set of numbers. We're very clear on what our plan was of how we're going to deal with COVID, and you can see from the numbers that the management action that we took meant that COVID had minimal impact on our income. We essentially restructured our cost base very early on. That was back in sort of March last year, and we've remained highly cash generative. We've also remained acquisitive, so we're very keen on, even through the COVID period, we have remained acquisitive. Another point that I'll raise in this particular slide, or the final point on this slide, is just to say that we also made the decision as a board at the end of last year to repay all of the COVID-19 grants and furlough money that we received in the whole of last year. We don't have any staff on furlough now. We're not receiving any grants, etc., and we decided to repay all of the furlough and grant money that we have received. That was just a board decision to be socially responsible. So, and the sum total of all of that action really was that our 2020 performance exceeded management pre-COVID expectations. So we achieved our pre-COVID business plan despite COVID. Okay, so on to financial review, and I'll hand you across to Louise to cover this section.
Okay, thanks, Dorian. So just on our profit and loss account, as Dorian highlighted, revenue's up 13%. And in actual fact, we had revenue growth. I didn't touch it.
Moved on. That was my fault.
Let me go back.
Yeah, got it.
Sorry. We had revenue growth across all three markets. So lettings was up 10%, sales was up 21%, and financial services was up 14%. Just to highlight on the P&L account, we've pulled out as a separate column the trading from the Lavelle corporate-owned offices. So when we acquired Lavelle, there were 12 franchise offices and 12 franchised offices and 5 corporate-owned offices, and it was always our intention to find a franchise solution for those. 4 of the 5 went by the end of the year, but 1 went just in the middle of January 2021. So we're now fully franchised across Lavelle. But it means that you can see exactly the impact that the corporate offices had in 2020. Effectively 900,000 of revenue, 800,000 of costs. But next year, what we'll see instead is about £100,000 worth of management service fees going forward. It's probably also worth just pulling out the other income of 123,000 is actually a gain that we had on the sale of some shares we owned in Mortgage Advice Bureau. So as a result of the acquisitions we've done on the financial services businesses of Brook and of Mab Gloucester in recent years, we actually held 40,000 share options in Mortgage Advice Bureau that vested in May, and we sold them in August. So that's a profit that came through on those. And if I just jump to the next slide, just looking here, you can see revenue up 13%, that's 2.4 million. Of that, Lavelle added, the Lavelle acquisition added 1.1 million, and that was 6% of the revenue growth. But 7% growth came from the underlying business, and that added 1.3 million. And if we dig just a little bit deeper, if we exclude Lavelle from the property division, the underlying property division grew by 2%, and the financial services division grew by 14%. I'll come back to the MSF, that grew by 300,000, but I'll come back to that on the next slide. Our corporate office income was up £900,000, but that was entirely due to Lavelle, and therefore it will go back to its previous level next year. On the gross profit ratio, lettings represented 60%, that was down from 61% last year. So there's a little bit of a switch over between lettings and sales, but that's really because of the fact that we'd invested in Lavelle's, and that was predominantly a estate agency. Other than that, it was all fairly static. On the admin expenses side, they were up 600,000 to 8.2 million. But if we bear in mind that Lavelle itself added costs of 900,000, and there was an additional share-based payment charge of 200,000, and we can see that there was a saving of 500,000 in the underlying overheads, and they mainly arose from the sort of cost reduction exercise we did at the start of the pandemic. And as Dorian, I think, mentioned just a moment ago, in the first half last year, we did report to investors that we had benefited from 260,000 of government financial support from COVID and furlough and the small business grants, and that we fully repaid by the end of the year. So this is the MSF slide I just said I'd come back to. I used to report this slide to investors a few years ago, and for a long time, and then stopped a few years ago. I thought perhaps people might get bored with seeing the same slide, but we'd had a few requests to see it again, and as you can see, there's still an upward trend on our management service fee, and this is quite important to us because it is our core underlying revenue stream from franchisees. So last year it was up £300,000. Admittedly, 200,000 of that increase did relate to the acquired Lavelle network. But at the same time, we put in place a support package for our franchisees when COVID hit, a temporary support package where we reduced the minimum monthly MSF payable by franchisees, so that those franchisees where their revenue was really badly affected and fell below the minimum, they weren't being expected to pay the minimum, and that actually cost us about £100,000 in MSF last year. And going forward, we'll see the newly franchised Lavelle corporate offices adding about 100,000 in MSF. So just moving forward to onto the balance sheet, just a few lines to explain in a little bit more detail. The financial assets, which were 159,000, now zero. That is the MAB shares effectively being sold during the year, so they're no longer there. We have further down, there's assets held for resale of 591,000. That's actually the Lavelle Grimsby Lettings business, which was franchised in January, so that will have gone by now as well. The unearned indemnity commission, and bear with me on this, I always have to apologise in advance for trying to explain this one, but unearned indemnity commission is when we sell a life insurance policy, Mortgage Advice Bureau, ourselves, and indeed our advisors, we earn our commission up front on that. But if the person cancels that policy within 48 months, there's a clawback of some of the commission that's been paid up front. So there's a clawback on MAB, they claw back from us, and we claw back from our advisors. So MAB obviously don't want an exposure to their advisors, so they actually withhold some of our commission. It's in a bank account, effectively with our name on it. It's our asset, and that's within the UIC balances, in the debt balances, and that's 1.3 million. And on the other side, we have a UIC liability of 1.3 million. But of that UIC liability, we can recover 500,000 from our financial advisors. So that obviously is within the UIC debtor balances. So a bit of a confusing one, I think, in a way, but hopefully that explains it. On to a sort of slightly lighter note, and the year-end cash position was up 2.3 million. So we ended the year with 5.9 million in the bank. I think it's probably worth mentioning just here, as you appreciate from the earlier slides, we've acquired Humphreys for cash. That cost 4 million. But I'm pleased to say, as of today, our cash balance is still 4.2 million. So as you can see, even in the few months of the year so far, we've been fairly cash generative. The bank debt, we had bank repayments during the year of 900,000, so that took the bank debt down to 9.6 million. So net debt is down to 3.7 million by the end of the year. And if we look at our net debt to EBITDA ratio, that's at just 0.5. If I go on to the cash flow, as you're probably aware by now, if you've been following us for a while, we are highly cash generative, with 110% of EBITDA converting into operating cash flow. We used 2 million of cash last year to acquire Lavelle. Conversely, we received £200,000 for disposal of certain corporate offices. If I just touch on the franchisee loan book, so we extended loans to franchisees of 653,000. That was down on last year, and I think it's fair enough to say there was definitely a lower level of activity on the assisted acquisition side, and quite understandable really. Our franchisees were focused on securing their business and surviving COVID. They didn't want to take on the risk of an acquisition, and in actual fact the opportunities available to buy were fewer. I think people who were perhaps considering selling their business saw it wasn't a particularly good time of the year to go out and try and do that, so there just wasn't the appetite from a buyer or seller point of view. So there was less lending to our franchisees. Also, in terms of franchisee loans repaid, as part of our support package to franchisees, we allowed a 6-month a capital repayment holiday on franchisee loans, and that reduced cash inflow by £400,000. The proceeds from the sale of the MAB shares brought in 271,000. Just finally on the dividend, we paid an interim dividend of 5.4 pence, and that included a catch-up of 2 pence on the suspended 2019 final dividend. In our proposed final 2020 dividend of 5.1 pence, that includes a catch-up of 1.3. So if we look at the 2 years, making a sort of direct comparison, 2019, including its catch-up, would have been 6.7 pence. This year, the total dividend would be 7.2 pence, and there's cover of 2.1 times the dividend. So I think that covers everything on the financial side, and so I shall pass it back to you, Dorian, for the operating review market update.
Brilliant, thanks Louise. So on to the first slide, which is sort of growth across all 3 markets. What I'll do here, I'll just give you a general sort of overview. I'll explain some of the goings on within the business itself, and then the next 3 slides after this one really talks about our 3 different markets, sort of lettings, sales, and financial services, just to explain what's happening within the markets that we're operating in. So growth across all 3 markets. So franchise offices, you know, what have the movements been within our franchised offices that have resulted in the 318? So I've already explained about Humphreys with 21, so the 21 needs to be added on to the 318. But within the 318, we had 8 new franchisees join the group. What we don't have a sort of easy entry point, a home run type estate agency model, where it's sort of easy in, easy out. Our model is very much based around a franchisee having commercial premises, either an office or a retail unit. Franchisees on average are turning over just shy of £300,000 a year, which means they've got staff staff need to sit somewhere. So all of our franchisees are based in shops or offices. We had 7 new offices open in new territories last year. We dual branded 11 of the NBS offices. And what's happening at the moment with NBS is that we're currently dual branding a further 19 of the NBS offices. So we should reach the half-year point, probably by the end of April, actually, with 30 dual branded NBS offices. You know, another big step forward from the 11 dual branded that we finished the year on. And I'll explain a little bit more about that later on. 7 territories resold to new or existing franchisees. So, you know, within franchising, franchisees start their business at one point, and then 10 or 20 years down the track, they may want to sell, retire, do something else. They can do that. Their business has a value, and 7 of these businesses were resold to new or existing franchisees. We've had minimal consolidation of offices within our brand. And what I mean by that is that 5 years ago, when we embarked on this multi-brand strategy, so we made a decision to move away from just having one brand, we put a set of rules around how we wanted to operate going forward. And we said to franchisees that if you're a Belvoir franchisee, you can't buy a Newton Fallowell, and if you're a Newton Fallowell, you can't buy a Northwood, and if you're a Northwood, you can't buy a Lavelle. And the logic behind that was that we didn't want our very entrepreneurial franchisees to see an opportunity and think, you know, I'll cannibalise one of the other franchisees in the network. That would have reduced our footprint and been counterproductive. So what it means is if there's ever any consolidation within our network, it's normally where a franchisee who runs more than one office, and we've got about 50 franchisees who run multiple offices. It's really where one decides to close an office down, consolidate, and then maybe reopen somewhere else in the future. So it's normally second offices that get consolidated. The revenue split, I think actually this might be one of the questions in here from someone who knows us quite well. So the revenue split, if you forget financial services, the revenue split across our property division is 78% residential lettings, and it's 22% sales. I think one of the questions was, what's the sort of sweet spot really for us? Well, we've always been, for the last 5 or 6 years, we've run at 80-20, so it's been 80% lettings, 22% sales, and it depends on what time of the year you look at our numbers. So at the moment it's skewed more towards sales than it is to lettings, so 22% rather than 20%, and that's because we completed on the Lavelle deal, which sort of skews the numbers more towards estate agency. But please bear in mind, we just completed on Humphreys, which doesn't have much sales. It's nearly all lettings, so it goes the other way. And then, of course, we've got organic growth on both sides, both lettings and sales. So actually, my sweet spot is probably 80-20. That's where we've been, you know, for the last 5 or 6 years. I appreciate that a lot of our investors like the fact that we're underpinned by this recurring revenue. And I like the fact that we're underpinned by that revenue. It certainly stood us in good stead last year. So hopefully that answers one of the questions. Managed properties, steady rise. The managed property numbers on here at 65,000 doesn't include Humphreys. So that with Humphreys, it puts us at 71,500. Financial advisors, I've already said we're up to 212 actually with the 10 that we've brought on so far this year. We expect to see pretty good growth in financial advisors again this year. I know 1 or 2 of the questions have been around that too. And in fact, I'll cover that on one of the next slides, but yeah, I'll come on to that shortly. So mortgages arranged, just to give you an idea of sort of where we are in real time. So last year, we arranged 29% more mortgages than the previous year. So we wrote 12,000 mortgages. In Q1 this year, we've already written 4,000 mortgages, which is just a reflection of having more mortgage advisors and having more activity in the market. But we certainly started very well. So onto the lettings side of the market. So first of all, I'll sort of split the markets into 3 bits: lettings, estate agency, and financial services. Do you want to push me on that one, Louise? Thank you. So as you can see from the chart, please forgive me if there are too many stats on there, but if you have a look at the green dots, that just shows annual rental growth. So, negative growth in London last year, positive growth almost everywhere else. Very high demand and supply not particularly increasing, but supply did increase in London, as you can see, simply because the demand wasn't there ultimately, and also properties sort of switching from short-term lets to longer-term lets, which we did see that in a lot of the cities last year. I think London will return to positive growth again in the second half of this year. The main reason that it was in negative growth is that people weren't going to work in offices, and so therefore the number of house moves in that direction was lower than it would normally be. You've also got to bear in mind that rents in London are 87% higher than everywhere else, so rents are already at a pretty high level anyway. So across the board, according to ONS, rents increased by 1.4%. That's across existing tenancies, not marketed rents, which Rightmove and Zoopla normally report on. RICS are reporting increased demand. An index that's worth keeping an eye on is the Home Let Rental Index, because Home Let are essentially an insurance company, but they're also a referencing business. So they reference tenants at the point of a credit check. So they get to see achieved rents rather than market rents. So in real time, if you keep your eye on the Home Let Rental Index, it gives you a pretty good idea of where rents are right at this point in time across new tenancies. And the Home Let Rental Index is reporting to March 21, reporting rents increasing by 3.4%. Bear in mind that London has been falling during that period, so that translates to, in some areas of the country, recent rent increases on new lets of double digits. The East Midlands being one area, North East performing well, and eventually we'll see that sort of feed through to all tenancies. Another question that we sort of had throughout last year was about rent arrears, with furlough and COVID and unemployment and businesses being forced to close. The questions were around, could rent arrears reach 40% or 50% was one of the questions I had this time last year. You'll be pleased to know that our rent arrears hasn't been higher than 4%. It's normally around 2%. And in my opinion, with managing agents, rent arrears are normally temporary. So there are very few true defaults. Normally, the agent will work pretty hard to come to an arrangement between landlord and tenant to make sure that any rent arrears are made up for and that the tenant remains in situ, that they keep their home. So rent arrears, again, temporary, but at a pretty reassuring level considering the backdrop. So on to property sales. So again, this is being pretty well reported, in national newspapers. But in terms of where we are now, we can look back at 2020. We can see transaction numbers. So UK property transactions fell by 55% during the first lockdown. So we as agents, we were not allowed to transact during that period. We could do some work behind the scenes, but people weren't viewing properties. People couldn't view properties. Essentially, it was the full lockdown. There was a surge of activity as soon as restrictions were lifted, and we were unlocked at the back end of May last year. We expected to be locked down for 3, 4, or even 5 months. We ended up just being locked down for 2 months, which was very helpful. And then as soon as the restrictions were eased, we saw immense activity in the sector from pent-up demand. And this was really from people who had either fallen out of love with their property during the lockdown, or people realised that maybe this is going to go on for longer than they may have first expected. Therefore, they needed an extra bedroom to work from home, a larger garden, or they may have wanted to move out of a city and sort of head off into the provinces. We saw a lot of that happening last year. In terms of what happened in the second half of the year. So the stamp duty holiday was announced by Rishi Sunak in July last year. It was announced to run up until the end of March this year. That has now been extended, which I'm sure you've seen covered, which again, very helpful. The extension to the stamp duty holiday has simply avoided the cliff edge that of transactions that are stuck in a bottleneck because conveyancers can only handle so much work. So again, that's very helpful just to not so people don't miss out on the stamp duty holiday when their deals are just weeks away from completing. But again, the stamp duty holiday sort of poured fuel onto a fire that was already burning in the property sector. So we saw even more increased activity in the second half of the year. Why I sort of refer to 2020 as a bit of a roller coaster year, I think at times it felt as if it was sort of white knuckle as we sort of planned, for what was going to come next. And at the other times, it was exhilarating, really, with just the sheer level of activity that was being caused by external factors. So when we look back at the number of transactions, total number 1,044,000. Anybody with very long memories who remembers pre-financial crash may remember sort of transaction numbers of over 1.5 million per year, sort of as high as 1.6, 1.7 million transactions a year. So actually, we normally average about 1.2 million transactions a year, which still isn't at the levels we saw pre-financial crash. There are a number of reasons for that. Some people say, stamp duty is a sort of tax and causes immobility in the housing market, but the stats are what they are. So it was just over 1 million transactions last year. That was only 11% down on the previous year, which when I think back to how I was feeling in March last year, if somebody would have said, look, the housing sales market will only be down by 11%, I probably would have challenged them on that particular statistic. But here we are with just a shortfall. House price inflation of 8% for the year to December, for the reasons that I've mentioned, and an update on where we are again in real time. So I think this is one of the questions too. In terms of house sale transactions, Q1 2021 were almost 50% up compared with Q1 last year, and we were open in Q1 last year. We were only closed for the last couple of weeks of March, and so revenue this year so far is up 21%. So onto the mortgage side. Thanks, Louise. So again, a year of a sort of mixed year, really, in terms of mortgage activity. And you can see on house purchase and remortgage, the graph just shows at certain times of the year, house purchases were up, and at certain times of the year they were down. They were down at points when we were locked down, sort of the April-May period. During April and May, we did manage to retain about half of our normal mortgage revenue, and that was simply from mortgage advisors switching their attention to remortgaging and sort of working the client database, because they were prohibited from going out and sort of doing their normal business on, well, estate agents couldn't transact, therefore the advisors couldn't either. So first-time buyers were essentially locked out of the market last year as high loan-to-value mortgages evaporated. That sort of happened throughout the year. Lenders were releasing some high loan-to-values, but unless the mortgage broker sort of caught hold of those deals first thing in the morning, not enough were being issued to satisfy demand. So government has announced that they're committed to help sort of generation buy through a 95% loan-to-value guaranteed mortgage scheme. Now, I haven't seen any lenders scheme rules on that yet. I don't believe any lenders have issued them yet, but they certainly will do very shortly, and I believe that scheme will run till the end of next year. Interestingly, if you have a look at some of the studies around where the maximum impact of loan-to-value mortgages will be, it's in areas where property prices are lower, and the logic around that is that if you need a high LTV mortgage and you've only got a small deposit, if you want to buy in London, you need a six-figure salary to buy with a 95% mortgage. Therefore, in areas with low house prices, it's likely that this scheme will be better used. Our financial services firm, which is called Brook, trading as Mortgage Advice Bureau, is reporting record-breaking levels of mortgage approvals in this year. That you wouldn't be surprised to sort of hear that. So not many slides left, just a couple, and then I'll wrap up and we'll move on to the questions. So growth strategy in action. I mentioned earlier that I'd show you some sort of pictures. So Lavelle, first of all, that's one of our Lavelle offices that was acquired last year. And this may answer one of the questions. So in terms of the multiple that we paid for the business, when we first acquired Lavelle, 12 of the branches were franchised and 5 were corporate owned. So we worked through last year to franchise the remaining 5 corporate offices, and we franchised out the last one in January this year. We would have franchised them faster, but clearly we were hobbled somewhat by the lockdowns last year. So we've now moved that network from 12 franchised and 5 corporate to 100% franchised. So that reduces the consideration. So the fully franchised network has resulted in a net consideration of 1.2 million. Our EBITDA forecast is 0.3 million, so it's a 4 times multiple. And one of the questions that I've had come through is around the consideration of Humphreys. Will that consideration, the net consideration, be reduced as we franchise out the sort of 3 corporate-owned Humphreys offices? Yes, it will.
Yeah, you might like to know. We don't know what we're going to sell them for until we've sold them, but I would hope that it would reduce to, around 2 million, maybe slightly less, but around 2 million. And we would expect the operating profit from that, to contribute probably around £500,000 on that, on a fully franchised basis. So once again, a multiple of about 4.
Absolutely, thanks, Louise. That's good. And then sort of in the middle, you've got Nottingham Building Society. So they've got about 50 branches. We spent about 18 months in talks with NBS before they chose us as their preferred partner, their only partner. First of all, we helped franchisees to buy a few managed properties that Nottingham had been managing. It was about 300, that's all. But the main part of the relationship is the fact that if you can see on that picture, I appreciate it's a bit small, but if you can see the red branding in the shop window, that's Belvoir branding. That's where a Belvoir franchisee is occupying part of the premises and effectively transacting property transactions from within the premises in return for a sort of referral that's paid back to Nottingham. And a lot of the Nottingham's clients, of course, they're saving money. They've got ISAs. They're transacting with the Nottingham on one hand, but they also have properties, and they want to transact on the property side, which we can now do for them. But if you watch this space on the Nottingham, we've got more to come this year. And I say we, just to give you a steer on that, we think by the end of H1 we'll have 30 of these co-branded offices, and we're also working with NBS to deepen the relationship. As I say, some more to follow on that this year. And Humphreys, again, a picture of one of the Humphreys offices. Last but not least, this one is Louise. So our most recent acquisition. Humphreys is more of a student lettings business. So it's grown up as a student lettings business. If there are any landlords in the room, you may know that student lettings is a different style of residential lettings. A lot of the properties are HMOs, house of multiple occupancy, different set of rules, far tighter regulation, licensing in many areas. So it can be a bit of a minefield really for the landlord if they're not using an agent. So landlords can be very sticky on that side of the business. And if you can see on the screen, the key metrics were consideration of 4 million, 2.8 million of revenue in their previous year, and about 1 million of operating profit that may reduce as we sort of franchise that out, as Louise has explained. And then really just to sort of wrap up, so why invest in Belvoir? I mentioned our 6 brands. We're looking to grow this footprint. We've grown it effectively over the last 5 years, and as the footprint's grown, it's just given us a distribution network that we're now able to start to feed additional revenue streams through that distribution network, such as we're doing with financial services. We have other revenue streams that we are particularly interested in, but more to follow in the future. 24 years of unbroken profit growth, with EPS up 165% in the last 4 years. 12 years of average length of service across our management team, and 28 years of average, this makes us seem really old, 28 years of average industry experience. On one hand, it makes us seem old. I'm 46, coming sort of 47. The fact that we've got a lot of industry experience stood us in really good stead last year when we were sort of planning in what seemed to be a foggy outlook. We couldn't see what was going to happen next, so we had to call on our experience, and that was very useful. I mentioned earlier that a lot of our investors were attracted to us originally because of our recurring revenue. So 60% of our gross profit comes from recurring lettings revenue, and that's been stable for years. Diversification is working well for us. So on financial services, we've increased from 0.3 million in 2016 to 2.8 million of gross profit from financial services. And as I said earlier, we've got a pretty strong strategy for growth on that side of the business. And then on corporate acquisitions, the final square, we've acquired 7 businesses at corporate level since 2015, which include the 2 mortgage advice bureau businesses, Newton Fallowell, Northwood, and we're also helping franchisees to acquire and buy out competitors at ground level. We reported, if you do look back through our recent RNSs, we reached a milestone of 100 assisted franchisee acquisitions a few months ago. So again, to answer one of the questions, we still remain very acquisitive. We buy businesses at corporate level every year, and we have done since 2015, and that will continue. At a franchisee acquisition level, we do have a pipeline of franchisee acquisitions. It stalled somewhat last year temporarily because of the lockdowns and just because of the disturbance in the sector. And of course, franchisees didn't particularly want to acquire last year when they were facing sort of multiple lockdowns. But we see acquisitions returning back to sort of previous levels this year. And so the last point on the last slide, and we'll start working through some of the questions now. We have had a good start to this year, so performance is in line with management expectations so far. We're also supported by a very buoyant housing market, and all in all of that bodes well for 2021. So I hope you've enjoyed the sort of formal presentation. And then, Louise, shall we move on and
shall I just give you a few seconds just to read through some of those questions? There's a few things for the investors, perhaps, and if you want to put on your cameras, and then I will remove the slides for you guys as well. But ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review those investor questions submitted today, I'd like to remind you the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. I'd also like to remind you that your feedback is important to the company. Immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Dorian, Louise, obviously I'm mindful of time. You've got as much time as you like. I think you've touched on a number of the questions, but perhaps if I could ask you, there were 2 pre-submitted questions. The first question was, what is your view on future dividends and future M&A? And then the second question, perhaps I could throw out to you, and then we'll look at the live Q&A.
Definitely. I mean, I'm happy to do those ones if you want to, Louise. I think, firstly on the, so in terms of the dividends, I mean, we proved last year that even through a difficult period where, and we did choose to suspend a dividend temporarily, which we've now reinstated, we've proved that the dividend is uninterrupted and has been since 2012. And I think it's fair to say, Louise, now we've got sight of this year and the progress this year, that we do intend to return to a progressive dividend policy going forward. So just to comment on the dividend, the general sort of question about sort of M&A. Was that a question about M&A, Mark? Was it on the pipeline?
Yeah, it's basically what's your view on future M&A? I think just broadly expanding on that.
I think, yeah, I mean, hopefully on the last sort of slide, I sort of covered that one off, Mark, in saying that, we've acquired at corporate level, decent businesses such as Humphreys and Lavelles, Newton Fallowell and Northwood. We've acquired, more than one business every year. So we do see that continuing. The sector is still very much ripe for consolidation. There are around 20,000 individual estate agent and letting offices dotted around the country, the majority of which are still independent operators. So we still see there are plenty of targets, both at corporate level, at franchisee acquisition level. Again, I said we'd reached the milestone of 100 successful franchisee acquisitions. We're good at them. We have our own team. They're on our payroll. We don't outsource that function, and we see that continuing. And then really the only other sort of possible M&As, would we get together with a listed firm? Could there be a coming together at sort of franchisor level? I'd probably say never really, I think is the point. We're open-minded. I think that not just us, other franchise businesses have proved that, with scale you can deliver shareholder value. So it is worth doing these deals, and we're open-minded really as to what M&A happens in the future. But we do have, we have targets in mind. We still remain very acquisitive in terms of sort of corporate acquisitions. And if you look at the numbers around the Lavelle acquisition, if that's a 4x multiple of EBITDA, we would happily do as many of those as we can do.
That ties into one question that's that's been put up. Why pay a dividend if you can reinvest cash in the business at 20% or more, shown the last acquisition? But I think the fact there is we have a lot of investors that have invested in us as an income, as an income fund, and therefore there has to be a balance between providing that dividend return to our investors who are relying on it from an income point of view, as well as investing in the business and taking it forward. And that's why there is a balance between how much we retain and how much we pay out as a dividend.
Definitely, that's helpful. And what was the other pre-submitted question, Mark?
Yeah, sure. The other pre-submitted question, very much in keeping, is how are you finding the bidding process when making acquisitions? Is it more competitive, and what makes you a preferred bidder?
I mean, it hasn't particularly changed in the last few months. And if I use Humphreys as an example, Nick Humphreys said when the deal finally closed, he said in a sort of press statement that he'd spent many years, most of his life actually, I think working. I think he started doing this when he was about 16. Spent most of his life building, this business that meant a lot to him. And on exit, he wanted to find a good home for his business. And so I think Nick, I wouldn't say that necessarily that some of these deals are driven purely by a multiple. It's about finding a good home for the business. Geographically, he happened to be pretty close to us, but I'm not sure that was either here nor there. But I think a lot of franchisors do feel loyal to their franchisees, and they want to put them with a good franchise home, really. So we've not seen any meaningful change at franchisee level. We'll still see multiples push up a little bit, possibly. If some of the stronger companies have been preserving cash and they want to deploy, maybe that will sort of increase the multiple of franchisee acquisitions temporarily, but we haven't really seen that happening as yet. And I've got a few, Mark, if you don't mind. I've got
I was going to direct you to that Q&A tab, and if I could just ask you to read the questions out, perhaps who it's from, and I'll pick up from you when you're ready. Thank you.
That's great. Yeah, fine. I'll try and do them really quickly as well, so to get through some. So from Henk, if I'm correct, the number of mortgages arranged is up by 30% year on year, whereas sales from FS is up by 14%. What explains the decline in revenue sort of per mortgage? I think I know what you mean by that, Henk. And I think we, like all agents and like all FS firms, we have pipelines that are much bigger than they would normally be, because we've been selling lots, but the time to get a transaction through to completion has just got longer and longer and longer. It's actually now up to about 6 months. So if your question is around a sales versus conversion, just the sheer volume of sort of transactions may explain it's just a delay in terms of timing. There isn't a decline in sort of revenue as such. The revenue per mortgage, the average case size, is about £1,600 per case. That's the average revenue into Brook per mortgage, which hasn't declined. So that's just, I think that answers your question. If not,
I think it's because when we say mortgages arranged, it's mortgages written. So it's a bit like when you talk about house sales, it's houses are sold subject to contract. Not all of them actually get to an exchange point of view. And also, so some of them will drop out along the way, and also there is just that time lag. And there was such a big burst of activity in November and December on the sales side. Some of those sales that affected the mortgages will have fallen into the 2021.
Interestingly, on that point, Louise, with FS, it differs with estate agents. So that estate agents will normally say that about a quarter of their agreed sales fall through. It's less than that on the FS side, because if you've arranged a mortgage with a mortgage broker and your sale falls through, You may or may not buy through that agent again. Just depends on who's got the property that you want to buy. But you probably will keep your mortgage with the advisor, so the fall through rates are different. It's
Yes.
it's sort of maybe 15% on one hand and 25 to 30% on the other. But just interesting point. So I think we've covered the question around M&A pipelines. We had another question from Scott M that said, in your opinion, what's the perfect blend of sales lettings? I
Which I think you've covered.
It's about 80-20. Just wanted to publicise that one. Let's have a look. Another question on corporate M&A, which I think we've pretty much answered. Let's have a look. Right, John H. Hi Dorian, great results in the current climate. What are you most excited about in the coming year within the business? And I appreciate John H. is a shareholder. So what gets us excited? I think we're actually, last year we were excited by lots of parts of the business. I said earlier that it felt like a roller coaster. At some points it felt, especially early on when the pandemic was sort of unfolding, it felt like a white knuckle ride where we were gripping on and hoping not to be sort of thrown off. And but then as the sort of year unfolded and some of the actions that we'd taken started to sort of bear fruit, it actually became exhilarating last year, really, with especially on the property sales side. I think it's very fortuitous that we have a very strong financial services business at the same time as we've got mass activity in the estate agency sector. So, if this activity continues, and there's no reason why it shouldn't, we will not only benefit from the increased footprint on estate agency, but we've essentially got almost twice the footprint if you overlay financial services. We've got another business that benefits from high volumes in estate agency. So that bit. So I'm excited about FS. I'm excited about estate agency in general. I'm pleased that we didn't lose any franchisees during the pandemic, either for business reasons or COVID reasons, because I've known a lot of these people for a long time, and I was determined not to lose anybody at the start. And I thought, we can't lose any offices or lose any people, and so I was excited that we sort of got through it, with our network intact. And then I think the additional services that you've probably heard me say a number of times, John, that I'm personally interested in: block management, build to rent. We're good managing agents, and different to online businesses, we have lots of boots on the ground in these local areas who are experienced in property management, so we can manage almost anything, anywhere. And I think exploring that avenue it would be very, very productive for us. I think commercial property is a bit on the back burner. It's something that, again, I'm personally interested in, but it's probably not the right time in the market sort of cycle to be looking at commercial property right at this minute, but maybe at some point in the future. Another question was around the diminution of the 4 million of Humphreys from
which we've
covered. So yes, it will. The net consideration will come down. John H, maybe a different John H, has asked whether we foresee any further tie-ups with MAB to accelerate financial services. I think the short answer to that is yes. In that we maintain an extreme, as you would expect, we're one of MAB's, in fact, we are MAB's largest key account. Their largest account, I believe, is their Scottish business that they acquired. So in terms of key accounts, we are the largest one. If MAB have, I don't know, is it 1,400 advisors? Over 200 of those are our advisors. So they're very motivated to see our business continue to grow and to continue to exceed, the same as we're motivated the other way around. So yes, we do, and I think it's an exciting partnership is my sort of view. So back to the other John H question, I get excited by that part, that's
I'm going to say, and I think we're quite excited by what we could do further with Nottingham Building Society as well. I think that's a kind of slightly different avenue to our normal growth, but that offers opportunities as well.
Question from Bill H. How many of your competitors operate a similar franchise system as Belvoir? And in terms of size, where do you rank versus the competition? That's fairly straightforward, Bill. There aren't many franchisors of our size. You've got, in terms of listed firms, you've got TPFG, and you've got Wentworth. The other listed property firms do, like LSL, have a bit of franchising in them under Reed's Reigns and Your Move, but as specific franchise businesses, there aren't many of us. In terms of rank and size, it depends how you measure us. But we are, until TPFG, who've recently acquired the Hunters business, in terms of office numbers, TPFG, I presume, are bigger after that. I haven't worked it out, but I presume they're bigger. And then Wentworth sits kind of underneath us. In terms of profit, across those two businesses, not sure. We'll need to see how this year pans out. So it depends how you view sort of size. Scott M, is the cost of a franchise MSF going up or coming down? I mean, MSF has increased every year. If that was the question, which was illustrated by Louise's graph, MSF is always on an upward trajectory, and franchisees, in terms of the size of their businesses, are generally growing each year. That's where MSF comes from. We've got some franchisees now running businesses turning over $1 million, and we've got a number of them, not just one. We've got a list of franchisees at that level. So we know that if the average franchisee is turning over about 300,000, we know that regardless of where they are in the country, they can grow that business to $1 million of turnover if they're so inclined, and if they're willing to adopt and take on initiatives like FS and acquire competing businesses within their territories.
But also on that point though, Dorian, the actual percentage MSF our franchisees are paying has remained the same. So it is purely growth that drives. It's not the actual percentage that the franchisees paying hasn't changed, has it?
No.
I just think that's an important distinction. The growth that we're seeing on that graph is from the franchisees themselves growing, as opposed to us charging them more.
So we haven't put our MSF rates up ever. I say ever, sort of certainly since we've been listed. I think the only time we put MSF up was probably back in maybe 2006, 2007. It was a long time ago. So another one from Scott M. Do financial services perform stronger out of sales-focused agencies? Yes, definitely. But saying that, what shouldn't be overlooked is the strength of the landlord mortgage market. So I'm a landlord, and I've used MAB for buy-to-let mortgages for the last few years. But because I've used MAB for buy-to-lets, I've also used MAB for my main mortgage when I moved house 3 years ago. Once a client has got a relationship with a mortgage advisor, they continue to transact. So if my point being, if a mortgage advisor develops a relationship with a landlord with 10 properties, chances are that will be 10 mortgages over a period of time. It won't just be one. So that's still a relatively untapped sort of area for us. But needless to say, a mortgage advisor in an estate agent has access to more immediate business, definitely. So Ian R, fantastic year, Dorian, Louise, thank you. Any reason why we can't continue forward with a similar level of growth? In particular, the FS area looks ripe for growth. What could hold it back? I mean, it's always a difficult one, and Louise has just spent an enormous amount of time and effort putting together our annual report. So that now is out, and it's on our PLC. It's on our group
you
PLC
can download it now.
there's the plug. If I hadn't have got that one in, you'd have kicked me tomorrow, Louise. So, but it is there, and if you want to have a look at the true risks, they're all mapped out in the annual report. But what can sort of hold it back? Well, I mean, on the rental side, that's been frighteningly stable, no matter what's being thrown at it. So anybody who's followed us for the last 5 years will know that landlords in particular and agents have been through quite a torrid period, really, or it certainly felt that way a few years ago, where landlords' costs were going up, and it almost looked as if there was a government campaign to sort of rid the sector of landlords. And I had people ask me that question: are government trying to get rid of landlords? But how we used to answer that, I'd say, well, the only problem is there are 13 million people renting. Where are they going to live? We're not building any social housing. It's lagging. The social housing sector hasn't changed in size or proportionality of all tenures in the last 10 years. So really, their only alternative is to buy somewhere, and not every tenant wants to buy. I think the good thing is, over the last few years. I think people now understand that a lot of tenants do want to remain tenants by choice, not necessarily because of circumstance. So my point being, I think the PRS will remain pretty stable, but I do think rents are going to increase pretty aggressively over the next year or two, unless something changes. I think on estate agency, I think that, I think government's got vested interest in seeing that, confidence in the housing market remain in place for the next few years. So I think we'll clearly benefit from that. And as you rightly say, FS, I think it's just everything to play for as far as we're concerned. We're doing well with it. No other franchise business is anywhere near us in terms of FS numbers. And, if you sort of project forward our growth on FS, where we'll be at the end of this year in terms of advisors. Well, we're at 210 already from sort of, we 10 up so far in Q1. So if we just carry that forward, we could end up at sort of 230, 240 at the end of this year. And there aren't really any reasons why we shouldn't, that's the fact of it. So another couple of questions. So Nicholas Humphreys, why did the vendor sell? Well, I spoke to Nick on the day of completion, and he said, Dorian, I'm really pleased. He said, I'm going to put my feet up. Nick's a nice chap, the guy, Nicholas Humphreys. He's a property chap. He left school and went straight into property at 16. He's built an extensive property portfolio, which I believe numbers hundreds, not tens. And he's going to retire, let an agent look after his properties, Humphreys, and then just take it a bit easier. That's the reason. So it's a genuine sort of early retirement case. Nick's in his sort of early 50s. Manu C has asked, what are management expectations for 2021? Well, that's straightforward. You just need to refer to the FinCap note on that. We have got numbers out there. FinCap have got them. Let's have a look. So Richard S, thanks for engaging in presentation, and thanks for steering the company through a particularly difficult time. We mentioned other revenues we might be interested in exploring. Could we elaborate? There aren't really that many that I haven't mentioned so far. It's sort of block management could be a big area for us kind of going forward. That's something we're working on at the moment. Financial services, we've got unfinished business on that side, so we're not sort of rushing to move on from FS to something else, because that wouldn't make any sense. We are, as you can see, becoming very good at the FS side. So yeah, sort of block management, commercial, possibly, and there are one or two other areas that we sort of looking at, really with a view, as you rightly say, to driving new revenue streams through franchisees. We've got the distribution network, so almost anything that a property agent can provide, we in theory could provide centrally and feed that through our franchisees on a win-win sort of scenario.
If I just pick up Mazin's question about the gross profit from the Nottingham Building Society partnership, I think that's something that sort of investors have to understand. It was our franchisees who acquired the estate and lettings business of the Nottingham. So in effect, we're earning MSF off of the business activity that they've done from what they've acquired, and it's very much reported to us within their results. So I couldn't say to you specifically, oh, we've earned this amount in gross profit. It's just part of the incremental MSF from our point of view that our franchisees who've taken on their estate and lettings agency are generating. I think Scott has just kind of given us, yes, we got there with the MSF question. That's fine. Just on the IPO, have you ever tapped the market for equity since your 2012 IPO, given your asset-light business revenue? We have actually. Back in 2013, which was before I joined, the company raised about £5 million on the stock market, and it was what we earmarked for our assisted acquisitions fund, which actually at the moment the loan book is only about 3 million, but we raised 5 million. We lend it out to franchisees who acquire business. They pay it back over a period of time, and it's getting lent out again. So it's kind of recycled continually. So that's been, I think, one of the most profitable or the best sort of fundraisings I think we did in terms of how we've used it. We did then raise, I can't remember how much now, but we raised some funds, probably about 6 million, when we acquired Newton Fallowell, and we raised money to do that. We also raised funds when we acquired Northwood. We funded some of that in bank debt and some of it in equity, which actually helped us broaden our shareholder base. We had a much smaller shareholder base prior to that, but because we've done those quite substantial fundraisings, we did actually bring on board more institutional investors. So we've got a very solid and very strong pedigree in terms of our institutional investors. But over the last few years, with the sort of smaller deals we've done, we've actually tried to do those mostly from bank debt. It makes the acquisitions more accretive because we're not tying into ongoing dividends and cost of raising money.
Dorian, Louise, I thought I'd just jump in, as you've been very generous with your time and address the many questions that have come in. But before any more come in, I thought I'd just perhaps just interrupt and perhaps ask you for a few closing comments to wrap up with. I know investor feedback's important to you, and we'll redirect investors to do so after that.
No, I think we've pretty much covered anything. As I say, we're looking for. We've had a good start to the year. we can see that we're sort of in line with our own expectations this year. And I must admit that trying to forecast what was going to happen this year was quite tough. Because we're coming out of sort of COVID. It wasn't very clear at the start of the year where we'd end up with the most recent restrictions. And I think we're actually very glad that we've been allowed to operate at almost all points really through COVID, apart from that 2-month very short window. So yeah, we're looking forward to what I suspect will be a pretty buoyant market really on all fronts for the rest of the year. I actually think now, because we're just starting to unlock, aren't we? I think the pubs are opening and shops and everything else, but I've not been to a shop today because we haven't been able to get out anywhere or go anywhere, which is fine. But I think in terms of the pent-up demand in the housing sector, I think agents will be mown down by the people sort of looking to do things in this at this time of year. The sun's coming out, and generally it's a very active time of year for us anyway. You put the pent-up demand together with that I think people have been pretty frustrated over the last few months, and I think then the end result will be a pretty buoyant sector really for the rest of the year.
Many thanks.
I think just a final point for me, just to flag up, I know you share this presentation, but the presentation we're giving to investors is on the Belvoir Group, and it is the belvoirgroup.com website it's on. And the annual report is also up on the homepage of the website. So it would be great if investors want to see it, to go and have a read.
Brilliant. Dorian, Louise, thank you so much for updating investors today and for giving us so much of your time. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide feedback. If you access this meeting from our website, then the feedback page will appear. If you access this meeting from the link sent you by email, you'll simply be asked to log back in to then provide your feedback. And if you could allocate a few moments of your time to do so, that would be most kind. On behalf of the management team of Belvoir Group, I'd like to thank you very much for your time this evening. That concludes today's session. Good evening to you all.